Let's see, has it started? Yes. Okay. So hopefully today we will be successful in getting this recording going. And if it is, then I will be able to share with you a link, yeah, to listen back to what we have discussed today. Okay, let's jump into our topic here, yeah. Okay, so today's topic for discussion, working capital. Yeah, this is a relatively important area, quite popular with these examiners anyway. So what is working capital? You will remember we said that in corporate finance, working capital means long-term money used to finance the current assets. That is why when we measure working capital, we say that it is current assets minus current liabilities. Current liabilities represents the short-term finance in a business. So what we are saying is current assets must not be financed exclusively with the short-term money only. They must be financed also uh, using long-term money. Yeah. Okay. I think yeah, people still coming in. Okay, so this is why when we look at the working capital ratio, yeah, the ratio is the overall ratio for working capital is that, or we call it the current ratio, which is CACL, yeah, very famous ratio. I think most people who have had a brush with accounting or financial analysis, they know current ratio is CACL. Why CACL? Because what we are saying is that current assets must not be financed exclusively using current liabilities. Current liabilities means short-term finance. There must be some long-term money financing the current assets. Yeah. And overall efficiency is of course based on this. This current ratio must be greater than 1 as evidence that there's positive working capital. If you look at books of accounting, some of them tend to be very prescriptive, you know. Last time they used to say, oh, this working capital ratio must be 2:1 because we want to make sure there is enough of short-term assets, current assets, uh, to pay off your current liabilities. Well, yes, that's not entirely wrong, but the real reason from a corporate finance point of view is that we want evidence that there's a buffer of long-term money to ensure that we can pay current liabilities on time and at the same time support the business operations, which are basically the use of the current assets. That is your inventory, if you're an inventory-based business, and certainly the accounts receivable. Yeah, okay. That is sales. Working capital cycle comprises, you must distinguish between this word, working capital and working capital cycle. Working capital cycle is basically a time period, inventory days plus accounts receivable. That is our money tied down in inventories. On average, how long is our money tied down in our inventory? On average, how long is our money tied down with our debtors, accounts receivable, minus on average, how long is our creditors' money working for us in our business? So that's the working capital cycle. Some books call it net working capital cycle, but normally when we just say working capital cycle, we know it's already net of the creditor's benefit. Yeah. So what are inventory days? Inventory days are simply inventory uh, divided by cost of sales multiplied by 365. You get the answer in terms of days. If they ask you days, then this is the version of the formula you use. Yeah, inventory days, accounts receivable days, and accounts payable days. Please notice that inventory and accounts payable, you can use cost of sales. Now for accounts payable, if they have given you information about purchases, then this formula here um, can be accounts payable divided by purchases, yeah, multiplied by 365. So if you want in your notebook this morning, you can just make a note to yourself. Accounts payable days can be accounts payable divided by cost of sales times 365, or it can be accounts payable divided by purchases, total purchases, yeah, times 365, if that information is available. Usually it is not, because usually they'll give you an extract from the statement of profit or loss, and in the statement of profit or loss, you have revenue, cost of sales, gross profit, da 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 da, yeah, so on and so forth. So you will have accounts payable days, which comes off from the sum of inventory days and accounts receivable days. Yeah, that's what it is. Now, examiners sometimes like to ask you the same information but expressed in terms of turnover. Yeah, turnover. Uh, Now, again, for turnover, there are two versions. The basic version that I've already written down here for you. Turnover simply means sales or cost of sales divided by an asset. Yeah, then you call it turnover. A turnover ratio is basically a cost or revenue generated, a income or cost flow divided by asset, then we call that turnover. But if you take the revenue divided by the assets, then it is called asset utilization. Yeah. So I will show you that in a moment. If you want to express these same ratios, like inventory days is inventory over cost of sales, isn't it? If I flip it and I say cost of sales over inventory, and I forget about that 365, I get inventory turnover. Yeah. Again, accounts receivable divided by revenue multiplied by 365 is receivable days. If I flip it, revenue over accounts receivable, I'll get receivable turnover, and for the total assets that we have, usually we call this asset utilization. We take revenue divided by total assets, and if we flip it over, we get total asset turnover. Yeah. Now, if I look at this total asset turnover, I can actually analyze this. Sometimes this ratio, yeah, this ratio can also be analyzed as, you see, if overall we call it asset utilization, yeah, asset total asset utilization, that's what we call it, total asset utilization. And total asset utilization, we get it as revenue divided by total assets. And you can analyze this into fixed asset utilization. What would that be then? What do you think? It should be revenue divided by fixed assets. Okay? Or if you like, nowadays we upgrade this, yeah, we call it non-current assets. Okay? Then that is fixed asset utilization or non-current asset utilization. If I have current asset utilization, they could actually just modify the formula a bit. I think at this point, when you are doing your revision, you need to understand, don't just try to mug up a ratio without understanding it. You should know what the ratio does, because this is a professional paper. You can expect the examiner to tweak the information a little bit, so that you will be required to tweak the formula a little bit. If you understand what you're doing, that shouldn't be really a problem, yeah? Current asset utilization would now be revenue divided by current assets. And this current asset utilization or turnover, we call it, yeah, is also called total asset utilization. Let me put this way. This is also called total asset total asset turnover. Yeah, and this is also called non-current asset turnover. So don't let the lingo get you into trouble. Yeah, and this will be current at turnover. Now, this current asset turnover can be analyzed into an inventory turnover or uh, accounts receivable turnover. Those are the components. So when you are looking at just purely the turnover, uh, then you use revenue for everything. Revenue divided by inventory, revenue divided by accounts receivable. But depending on the information, sometimes you may need to just take uh, the cost of sales divided by uh, the inventory. But when it comes to receivables, accounts receivable, because receivable means debtors are related to sales, inventory is related to cost of sales. So when you are doing the turnover for uh, inventory, you will use cost of sales if that information is available. Okay, now I know that on a Sunday morning, if I talk things like this to you, that's going to be troublesome. So here's an example. Yeah, let's say we have revenue 88,000, cost of sales is 68,000, so gross profit 20,000. Yes, and from the balance sheet we got inventories 8,000, accounts receivable 12, cash and cash equivalents 2, and total assets is 100,000. Yeah. And then on the other side, financing, we have accounts payable 15,000. So if we wanted to create a working capital cycle computation, then inventory days, following this formula, inventory divided by cost of sales. Yeah. So it would be inventory. We call it inventory days on hand actually, but I'll just put days here, would be equal to 8,000 in brackets. Yeah, because inventory is related to cost of sales, so divided by 68,000 multiplied by 365. That's what I would do. Accounts receivable, on the other hand, AR days, we would work out based on 12,000 divided by revenue, always by revenue. Now, inventories, sometimes revenue, sometimes cost of sales. So how do you know which one to use? Well, it depends on how the examiner has given you the question. If they give you cost of sales, use cost of sales. If they only gave you revenue, you can use revenue as well. Yeah. So accounts receivable days is always revenue, by the way. 88, 1, 2, 3, and multiply by 365, because we want to know on average how long is the firm's money tied down with other people. Inventory days, we want to know on average how long the firm's money is tied down in their stocks and inventories on average. Yeah. Because it isn't as if that you order 3 containers of stuff and you're going to use it up within a day. Not likely, isn't it? So if you order one batch of raw materials and things like that, and if it takes you a month and a half to actually consume it before the next one comes in, so that means on average it takes you about 45 days, month and a half, 30 plus 15, 45 days your money is tied up in that batch of stock. That's what we are trying to measure here. Yeah. And accounts payable would be the same thing. You would take AP days, which would be equal to in brackets 15,000. If I have purchases, good, but here I have cost of sales only, so that's fine. I will use cost of sales and again multiply by 365. This will tell me on average how long I take to pay my creditors, my trade creditors. Yeah, so accounts payable is another word for trade creditors. Yeah. Mm. And I've done the maths here for you. The same thing, inventory days, when I do 8,000 divided by 68,000 times 365, I should get 43 days. I hope that you all had time to check my maths here. Yeah, so if I just put it here, let's see, function F2, 8,000 divided by 68,000 blue box divided by the red box multiplied by 365. I had to multiply by -1 here because my cost of sales is minus. Yeah, that's all. That's an Excel worksheet thing. When you do this manually, you don't have to. Yeah, because you know that you're measuring days. Yeah, and the same thing for accounts receivable. Yeah, 12,000 divided by 88,000, the sales, times 365. And then of course you have your accounts payable days the same way. Yeah, okay, so if we add up these three numbers, inventory days plus accounts receivable days and plus the minus of accounts payable, yeah, we will get working capital cycle. So you see, for this little example, this company, their stocks on average, every batch of stocks, their money is tied down for about 43 days. On average, people take 50 days to pay them based on the numbers. And altogether, that's 93 days. Their money is tied up in inventory and their debtors. But the good news is that based on the kind of credit period that they are given, based on the type of payment that they have to their suppliers' money in their pocket is for about 81 days. So from the 93 days minus 81 days, their working capital cycle is only 12 days. They have to tanggung, they have to carry the investment in inventory and accounts receivable on average for about 2 weeks only. Yeah. Okay, examiners, like I said just now, sometimes might ask you to do the same ratios as a turnover ratio. So inventory turnover is simply just the other way around, like we said just now. Yeah, uh, instead of taking inventory over cost of sales, I have now taken cost of sales over inventories. Yeah, 68 over 8. This is L27 divided by L32. Yeah, so L27 divided by L32. Yeah, so what am I doing here? I am taking here uh, cost of sales divided by inventory will give you your inventory turnover. Now sometimes, depending on the question, you may need to do revenue divided by inventory. If the examiner wants you to use revenue divided by inventory, then they won't give you cost of sales. But if they give you cost of sales, then this is how you do this. Yeah, your accounts receivable turnover will be simply revenue or sales, depending on what they call it, divided by AR, number of times. Yeah, uh, you can actually give credit, people pay you, give credit, people pay you. And this turnover, same thing, inventory, number of times our inventory comes into our system, is utilized, and then we order again. So our turnover 8.5 times. uh, Generally speaking, we say if this number of days is small, that means your turnover is turning fast, then this inventory turnover number will be high. So turnover higher is better. Yeah, higher is better, but number of days, shorter period is better. Yeah. Mm. For accounts payable, this will be, Gobind, I'm in class now. I call you in the evening. Yeah. Yeah. Okay. Um, So accounts payable turnover will now be cost of sales again, or if you want, you could use revenue if cost of sales is not there. But ideally should be purchases, yeah, if you have purchases, yeah, or purchases if known, divided by um, accounts received, accounts payable, AP. Okay, there you go. Maybe I should bring this a bit closer, right? Should I do that? Yeah. Okay, so that's the overall idea about working capital. Let's look at what your syllabus says. Yeah, your syllabus says nature and purpose of working capital, the working capital cycle, the importance of working capital management. So there's a little bit of theory here you can see. Yeah, for example, the financial impact of changes to working capital policies. Now working capital policy is something else altogether. Working capital policy, there are three types of policy. Can anyone tell me what they are? On your mic and shout your answer. Don't be afraid. It's a Sunday. Three types of working capital policy. What are they? I think I have shared with you working capital policy. Yeah. It was in the previous set of notes also. Please read the. Yes, say that.
EOQ, GIT.
No. That one is specifically for inventory. Yeah, that's also a policy. This one we are talking about overall working capital policy. There are three approaches to your overall working capital that
Oh
you
yeah,
can
I think
take.
I know, sir. It's a moderate, uh, what is this? Aggressive, moderate,
Yeah.
and then another one is conservative. Is it?
Excellent, excellent,
Okay.
perfect.
Okay.
That's what it is. Yeah.
Okay.
So, what does it mean? Balanced means that you use long-term finance for the long-term investment in the business. Yeah, that is balance. Long-term money for long-term investment. Uh, Conservative means you use long-term finance for the long-term investment plus a little bit of the short-term investment. Conservative, you use more long-term money. Aggressive means uh, you use short-term money for the short-term investment plus a little bit of the long-term investment. You're aggressive. Yeah, not too good. As a policy, you must be careful. There's a difference between policy and bad working capital management. Yeah, so if I was to write this like this, working capital policy, let's say here, working capital financing policies. Da da da. Uh, First policy you said is a balance policy, yeah? Uh, Balance policy, also sometimes called moderate policy. Moderate, middle of the road, neither Democrat nor Republican. Yeah, and let us say we have a balanced policy or moderate policy. This would mean that long term investment uh, is matched with long term finance. What is long term investment? Long term investment is, i.e., non-current assets, that's long term, plus permanent current assets. Remember this word, yeah? Permanent current assets. Permanent current assets is the minimum amount of your accounts receivable and inventory, because this there's always a minimum amount of inventories in a business all the time. There's always a minimum amount of our money tied down with our debtors all the time. So that's not short-term investment, that's long-term, yeah? Permanent current assets. What is the long-term investment in a business? Is it only the fixed assets? No. You should remember this. Long-term investment in a business is your fixed assets or non-current assets plus a portion of your current assets, yeah? Permanent current assets. So this is equal to your long-term finance. Your long-term finance means your long-term liabilities plus equity. That's the long-term finance. Yeah. I don't know if they might put some numbers to this. If they do, then you know that's the formula, not really terribly difficult. That's a balanced policy. In a conservative policy, um, long-term investment, take both. In a conservative policy, long-term investment uh, is lower than long-term finance. So non-current assets plus permanent current assets are actually less than. So what happens here is the long-term finance is used to finance the long-term investment in the business as well as part of fluctuating current assets. That is the short-term investment. Yeah. So current assets can be permanent, the baseline where the debtors and accounts receivable all the time, and then the fluctuating current assets, sometimes more, sometimes less, dependent on business activity. Yeah. So the long-term finance is used to finance the long-term investment in the business as well as part of fluctuating current assets. Yeah. Conservative policy, and then you have aggressive policy. Aggressive policy is I state it all in terms of long-term investment. Yeah. So aggressive policy is long-term investment is more than long-term finance. That means long-term finance is not enough to finance long-term investment. Long-term finance is less. Why? Because we are using too much short-term finance. Yeah. So long-term investments are greater than long-term liability. What does that mean? That means uh, the company uses uh, excessive amounts of short-term finance to finance current assets the company uses excessive amounts of short-term finance to finance current assets and part of uh, the long-term investment as well. That's what it means. Okay. I think Fatin having problem to sign in.
Not signing in, sir. It's just the chat is not functional for me. I'm not sure why.
Oh, the chat. Never
Yeah.
mind, just on the mic and chat with me like that then.
All right.
Yes, no worries. Okay. Anything else? Let's see. Okay, so this is what they mean by this, yeah, the type of policy. What happens to the current ratio? They may just ask you that, yeah. What happens to the current ratio if these policies are used? With a balanced or moderate policy, current ratio is balanced. Of course, balance. Balance means 1.5 to 2.5 in Malaysia is considered balanced. Yeah. Conservative policy here, uh, current ratio will be high. Yeah. Current ratio will be high. Maybe uh, more than 2.5. Because we have a lot of long-term money. Uh, when do you normally have a lot of long-term money? When the company has just completed the issue of shares or bonds. Then normally they are flush with long-term money. Then you will see the current ratio tends to go up. So if they give you a scenario where they say, oh, this company has just completed an issue of bonds or sukuk or something like that, and this is their financial position now, you can expect that current ratio will be high because they will be sitting on a lot of long-term money. Yeah, they just got it. Here, when there's an aggressive policy, here the current ratio will be tight. Tight, so meaning to say maybe 1.0 to 1.5 is considered a bit tight. Still good, still positive, is still good, yeah. But please note that at all times, if you're talking about policy means current ratio will always be positive. Now, note, if current ratio is negative, that is not policy, that is bad working capital management. Yeah. Note, negative working capital means less than 1, less than 1 is the result of bad working capital management, not policy. Yeah. So don't say, oh, they seem to be very, very aggressive. Their working capital is 0.8. Well, that's fine. No, it's not fine. Yeah, certainly not fine. Okay, there you go. The importance of working capital, the financial impact of changes to working capital policies, interpretation and use of working capital ratios, inventory turnover, collection ratio, what we just did, management of working capital. So this is the one, accounts receivable, credit terms, collection, discount policy, inventory, EOQ model, JIT, cash, accounts payable, da. So what I've done here is that I put down some notes here already for inventory management for us to save some time. Two main systems of inventory management. One is the EOQ model, on which they have both theory question as computational question. JIT is not really a subject of computational calculations, unless they give you a case study scenario, which I don't think is likely, because now the paper is called Interpreting Financial and Accounting Information. Yeah, so probably less emphasis on the case study management kind of thing. I don't know. I mean, I'm just taking a lead from what they have called the subject. But in any case, you must read up at least one good article on JIT inventory management. In my list of theory topics, I have given you links of certain articles and essays to read. If you read that 15 to 20 essays, it will help you. If you write something on that, it will help you 10 times more. And if you go through those topics and you have written your short notes to it, you have already got 50% of the marks. This is the strategy. Yeah, you've got 50% of the marks. The balance 50% of the marks depends on how much time, effort and energy you can expend to practice the maths. Yeah, practice the maths on the ratios, on the investment appraisal NPV, the maths on cost of capital, the maths on this kind of things, inventory management and things like that. Okay, so what's the maths here? Let's see. This is the EOQ model. Yeah, EOQ stands for economic order quantity, by the way. Economic order quantity. So what is this economic order quantity? It is the best order size. Each time we order something, yeah, the best order size. How much quantity? The best order size to minimize overall stock management costs. That's what it is. No more, no less. Yeah. Economic order quantity. That's what it is. How do we measure this? Well, EOQ, the lowest cost order size, is the square root of 2 multiplied by the fixed cost of placing an order, that's F, yeah, fixed cost of placing an order multiplied by the sales quantity for the year projected. Of course, because you're doing planning, so this is projected for the coming quarter, coming year, whatever, yeah, divided by CP, where CP is the cost of storing or warehousing one unit for 1 year. Yeah, that's CP. Now, so if we put all this data into this formula, then you will get what we call the overall minimum costs. This formula is basically based on the understanding that there are two types of costs in inventory. TIC means the total inventory cost, the total cost of managing your inventory, not buying. I always emphasize this to students. Do not think that this is trying to reduce the cost per unit of what you buy. That one is negotiation with your vendor. That's something else. That's negotiation. That's not financial management. Financial management is about how you manage the cost of managing your inventory. Now, what is involved in managing your inventory? Two things. Number one, ordering the inventory. And number two, keeping the inventory safe before it is used or resold. Yeah. So that's why we have total inventory costs are total ordering costs, the total cost of ordering and receiving your inventory, and secondly, the total carrying cost, that means the cost of warehousing, the cost of keeping the stuff safe. Yeah, the total ordering costs are the fixed costs per order, F, multiplied by the number of orders, S being the total sales, divide by EOQ. EOQ is the best order size, how much you order each time. So if total sales say 360,000 and you order 10 times, uh, well, then the total ordering cost will be the 10 times multiplied by the fixed cost per order. Yeah, and total carrying cost, simply CP, which I told you just now, is the cost of holding or cost of carrying 1 unit of stock for 1 year multiplied by average stock. And average stock we take as EOQ divided by 2. Yeah. So these are the definitions: total inventory cost, ordering cost, da 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 da. This model was created by Baumol. So sometimes the examiner may call it the Baumol model. Yeah, Baumol model. He's an American mathematician. Baumol model. Yeah. So Baumol model can also be used for cash, by the way. So they may actually give you the same question, but ask you to talk about what should be the best uh, balance on our overdraft account that you should maintain. It's a bit much for your paper. Normally, the papers which are more technical, like ACCA and all that, will ask questions like that. I don't expect they will ask for you, but if they do, just remember it's the same formula. Yeah. Only thing here, fixed cost of placing an order would become fixed cost of arranging credit every time. S would be the total amount of credit required, and CP is simply the rate of interest for $1. Yeah. So it works just as well. In the EOQ formula, we have said F are fixed cost of placing each order, S is the sales volume in unit, CP is the carrying cost per unit per annum. The assumptions are that um if this company uses this formula and it can minimize the cost, so we assume that the usage is quite constant. When it comes to zero or almost zero, we pick up the phone, we call the supplier, and we say we need 3 containers of this stuff. And the moment you put your phone down, the lorry is there already, no delay in delivery. Of course, that doesn't happen in real life. Yeah. So you can make some adjustments to the model. Actually, the adjustment is very simple. The model assumes no lead time. If you want to bring in lead time, you just calculate what we call a reorder level. When it reaches a certain level, you place the order straight away. So if you're going to get your stuff in 3 weeks time, you order 3 weeks earlier. That's all. Yeah, it doesn't impact the model much. It's an assumption which is not true, but which is not critical also. Yeah. Then the other assumption is single product from single supplier. This may not be true, but you can do it for each supplier. Is it painful? Is it difficult in real life? Yes, it is. But we still use it sometimes in real life because it gives you a rough idea of what you want to do. Yeah. Many of these mathematical models are not perfect, not by a long shot, but we still use them, not because we want to take their output literally, but because we want to just say that, well, this is a good guideline that we have. Yeah. Okay. Okay. Azura is not there. Uh, just give us a minute, please. Uh, please share your email. We are using MS Teams. Um, yeah, my mistake actually, because I told Azura we can use Google Meet. Yeah, I should have told her straight away no Google Meet, but I just wanted a backup just in case. You never know. Okay. So if there's a lead time, like I said, no problem. You can order earlier. Now, when market conditions and delivery schedules are uncertain, what you can do is you can provide for safety stock. Yeah, you can provide a safety stock buffer. Let's look at a simple case study so that we can understand how this works. A company is doing a supplier audit. Yeah. Let me just go in here and mark your attendance. I can actually do that, download attendance list. Mm. Okay. Uh, let me see if there's any message to clear. Zoe, are you okay, Zoe? Hi, Zoe. Zoe Lim? Okay, good. Okay, so back to this. Um, a company is doing a supplier audit. The current supplier charges 25 ringgit per unit, um, has a 2-week lead time for delivery, and involves order and delivery cost of 150, which means F, the cost of placing an order, yeah, F is equal to 150, cost of placing an order. A new supplier is being considered and he will charge cheaper a bit, 24.50 per unit, but will delay delivery by 3 weeks. This fellow deliver within 2 weeks, the new supplier takes 3 weeks and will involve order and delivery cost of 250 per order. Yeah, so F is 250 for old supplier. F is equal to 250 for new supplier. Um, company has budgeted sales of 104,000, so S is equal to 104,000, and the holding costs per year per annum CP is equal to 1.05. Yeah, and that's the EOQ formula. If you can, without looking at my answer first, can you do the EOQ for both the existing supplier and the new supplier? Yeah. And if you want to take a quick washroom break, now might be a good time so I can work out some administrative stuff here. Yeah. Let's get back to this. Uh, I will stop my recording for now. Stop the recording. Stop.